simulates this using a clock look to it. You have basically a drum here with a moving stylus that is programmed to react to all these different prices. So again, you have the same coordinates, 12, 6, 3, and 9 as your key levels. And this sets up rather nicely because this again is like maybe flying an airplane or looking at a lot of important data, and you quickly need a reference as to, where am I? Am I at 12 o'clock? Am I at 3? Am I up a quarter? Am I down a quarter? So you are exactly pointing to where you are. When the events happen and the trades occur, I want to see it. I want to see it quickly, and I want to see it clearly. I don't want to be looking left, right, up, down to get my coordinates together. I will grant you that they do have sophisticated software, and you can move a cursor and capture the absolute values. But again, I'm flying a plane. I need to know what's going on real quick, and I like this method here.
Juxtaposing the dials as shown here allows you to quickly see the price components involved in an option trade and the resulting volatility. Note that call options are positively correlated with the underlying futures contract. In the top example, the futures contract is trading with a one-tick gain. However, the call option is trading unchanged, and the result is a downtick in volatility. In the bottom example, the futures contract is trading unchanged on the day. However, the call option is trading with a one-tick gain, and the result is an uptick in volatility. So with puts, again, if the futures are unchanged and the put is trading at a higher level, well, then volatility clearly goes up. In the example here, the futures contract is up. The put option should actually be losing some value on a upward move in the futures, but as you can see, it's trading unchanged. So unlike the call that would lose some volatility, the put actually gains. The dials are carefully calibrated according to the contract specifications established by the exchange. The previous day's settlement for each dial is located at the 12 o'clock position. By juxtaposing the dials, the user can see clearly and quickly the value an option is trading at and the resulting volatility. In the example here, the volatility has been bid up by the fact that the futures contract is trading at up 3.5 on the day, and the put option trades with only a one-tick loss. Here is a bird's eye view of how the pits on the trading floor were arrayed. Typically, the underlying futures contract traded here. The pit was larger, reflecting the amount of necessary liquidity provided by the market makers and the brokers handling the order execution. The option pits were a little smaller and were located near the underlying futures pit. They had clear sight lines in order to facilitate fast communication and order execution. In order to replicate the price discovery dynamics developed on the trading floors and increase situational awareness, the Accutic system uses a series of dials to display price components involved when significant option trades occur. When the trading occurred on the trading floor in the option pit, as you're looking at here, they would quickly communicate, yell, scream over to the futures pit to hedge the trade that was occurring. The market makers base their prices on where the underlying contract is, so it's important that they quickly execute a futures trade immediately after the option trade occurs to lay off the risk. So here's how the alerts would work. You would select an underlying security. In this case, we're looking at a March 10-year note. Chart pulls up, and then we would go over and click on the Accutic alerts. So clicking on the alerts renders drop-down boxes showing active options exercisable into the March futures contract. They are sorted by volume, so we have a Feb 28 put most active traded 25,000, Feb 27 puts traded 11,217, March 23 puts have traded 4722, the March 25, 29 and a half strangle traded 2,500 times. And we got a Feb 28 and a half straddle traded 1,750. And the Feb March 129 call calendar traded 1,000 times. So in order to view this activity, you can select any one of these. We're going to start with the most active and click on that. Now we can choose to look at the trade detail on any of these alert targets. They are clickable. So we'll start at the beginning with this one and click on it. Clicking on one of the alerts, the details of the trade are shown below with the Accutic dials. So at the time of this alert, the futures contract was trading up one tick at 128.13. Again, the previous day's settlement is here at 12 o'clock. The 128 puts settled at 26 previous day. For this particular trade, they traded at a price of 25, which is down a tick on the day. 2,300 again traded here. Given the two inputs of where the futures and the option traded, you can see the volatility is just off a little bit from where it's settled based on these prior day settlement prices. So let's take a look at this next alert. Click on that one. As you can see, the market has rallied. We're now trading up 5 on the day, correct, at 128.17. The dealer buys another 1,500. He's paying 24, so the future, or the option rather, is only down a couple of ticks, and you can see volatility now is quite a bit higher on the day. Let's look at the next alert. So now we're at excuse me, 140 on the time, late in the day, kind of, and looks like the last batch is trading here, 5,000 bought. Notice that the futures haven't moved between these two levels. However, the market makers wouldn't trade it at 22 anymore. They wanted 23s. The guy paid up 453 on the vol. A lot going on here. Selling the option at a volatility level of 4.53 on 100 contracts is $1,562.50 more profitable than selling a volatility level of 4.41. Because the futures prices have not moved, the hedges are equal. So again, the hedges are what the market maker does when he trades the option, because these have a 33 delta. For every 100 contracts, he'll sell 33 futures to offset the risk in both cases. So those prices cancel each other out, leaving the only difference as the premium received, and that difference again is $1,562.50. So let's pretend we bought early in the morning and sold that late in the day trade. So here you're buying a low vol of 409 and later selling it at 453. So the initial trade, I'm going to buy 100 of these 128 puts at a level of 25. And to hedge that, I need to buy 33 futures at the current price of 128.13. Later in the day, volatility is up to 453. I exit the trade. I sell 100 of these 128 puts at a price of 23, and I offset my hedge. I sell out the 33 that I bought at a price of 128.21. So I've got an 8-tick gain on my futures on 33 contracts. That's 8,250. My loss on the option trade on just 2 ticks comes out to 3,125. Net gain 5,125. Being aware of the trade components and resulting level of volatility when large trades occur in the market increases your awareness of the overall trading environment. In the two studies where we compared the trade levels, you can see the amounts of money involved with changes in volatility. From a user's perspective, an example would be if you're bullish the market, you might want to consider selling a put option when volatility gets bid up versus buying a call at a high level of volatility, and vice versa. If you are bearish the market, rather than purchasing puts when volatility has been bid up on a given day, you might want to consider call selling.